Welcome to Lesson 4 and the halfway mark in our course. Lesson 4 covers chapters 6 and 7 of your textbook. Chapter 6 discusses internal controls and accounting for cash and cash equivalent items. Internal controls refer to policies and procedures that are designed to detect or prevent fraud. The authors list 9 different internal control systems. Number 1, separating duties so that a theft or fraud requires collusion. The idea here is that 2 people can keep a secret as long as one of them is dead. That's a quote from Mark Twain, by the way. Hiring and training competent employees is number 2. Number 3, bonding key employees, a form of insurance wherein money is set aside to cover any defects in workmanship or activity of the employee. Number 4, requiring employees to be absent so that a replacement can detect any fraud that has been taking place. You would think somebody who skips vacations is a model employee. Not exactly so, particularly in the accounting functions. Number 5, written procedures for processing transactions should be in place and followed strictly with very few management exceptions. Number 6, establishing lines of authority and responsibility. This points to who to blame if things go wrong, are misrecorded, or even fraudulently recorded, so we can trace. Number 7 involves using numbered documents. This is very commonplace. Checks, sales invoices, and other types of documents will be numbered. This allows the auditors and examiners to zoom in on those documents that may be missing from a series to find out what's happened to them. Item number 8 is using physical controls. This would be things like security cameras, fences, locked cabinets, and so forth, to actually physically control assets of the company and prevent them from being stolen, or as they say, developing legs and walking out the front door. And number 9 is to require regular performance evaluations and internal audits of the accounting system. Even the best system of controls cannot totally eliminate fraud. However, it can greatly reduce the temptation and increase the likelihood of early detection. Cash accounting is taken up next and is critical for every firm. If the business is unable to pay expenses, it will either be forced to borrow or go bankrupt. Cash includes not just demand deposits, that is, checking accounts, but also cash equivalents. The latter are generally short-term government and commercial notes that can be quickly and easily liquidated, that is, sold at no loss of value. This is so that the firm has a sort of a cushion. The reason not to keep cash balances in the demand or checking account is because it earns no money in that account. And so we adopt this policy of using short-term, high-valued, highly secure financial instruments in place of cash. Controlling cash assets directly, meaning currency specifically, is very difficult because of the ease of embezzlement and fraud. Cash has a relatively small bulk for very high value, and the rightful owner of currency is often hard to prove. Cash receipts and payments should be checked and verified by at least 2 employees. Bank statements should be reconciled with the true cash balance as shown in the adjusted cash ledger. Any errors in recording cash balances are recorded to a special account called cash over and short. An example of this document and this account appears on page 305. For items that are paid by currency rather than checks, we use a petty cash fund. This is typically a locked box with sufficient cash for small transactions. We establish the fund with a debit entry to petty cash and a credit to cash. As money is paid out, a receipt for each purchase is recorded and placed inside the box. Thus, the total of cash and receipts remains constant. When the cash runs low, the receipts are totaled and entered into the record with a single entry under the heading of miscellaneous expenses. Then the cash is renewed and we go on. The chapter closes with a discussion of the annual report, which is also known as the 10K filing. This is the name of the government document which all corporations are required to file at year end, whether that happens to be December 31st or the 31st of some other month as allowed. This report differs between the privately held and publicly traded companies, but it is required for all businesses so that they can pay appropriate taxes. The report consists of 4 items. The financial statements, there are 4 of those, as we will know: balance sheet, income statement, cash flow, and stockholders' equity statements. Part 2 is footnotes to the financial statements, and here the accountants disclose additional information that would not be contained or clear in the financial statements themselves. Part 3 are management discussions and analysis. No one should know better the state of the firm than those running it, and so they are required to write up a brief discussion of what business has been like for the past year and what is expected for the future. And finally, the auditor's report. It's important to note that the auditor's report never actually affirms the accuracy or truth of the financial records as examined by the auditors. Instead, the auditors do not examine every single entry, wouldn't be possible, and so they sample. And because this sample is potentially not representative of the entire population of financial transactions, the auditors are restricted to merely saying we give an unqualified opinion. That is to say, without qualification, we found no material errors in the books. This would be the highest and most desirable level of audit proof of the honesty and transparency of those financial documents. If a qualified approval is issued by the auditor, they will note what qualifications they had in mind so that potential investors and other business entities can look into those on their own. A negative or adverse opinion means that the auditors found substantial errors and or fraud that were not corrected, and that typically the audit firm would suggest walking away from this company. Firms that are publicly traded have stricter reporting rules established. In addition to the generally accepted accounting standards, they also must conform to the Securities and Exchange Commission standards. The SEC, of course, was founded at a time of the great financial collapse in the stock market in the 1930s. Chapter 7 presents accounting for receivables. We open with an explanation of how to record uncollectible accounts. 2 methods are allowed, or described actually: percent of revenues and percent of receivables. Either of these is effective, it just matters which one would rather work with. Also, the direct write-off method is shown. Firms with very limited accounts receivable can write them off directly, but this is not a common practice. Accounting for notes receivable is described next. A note is different from an account receivable, an account receivable, because it is documented with literally a note. The note will include the 2 parties to the transaction, the amount of money being loaned, the amount of interest being charged, the date on which it is to be returned, and if there is any collateral, that will be included in the note. The advantage of a note, by the way, over an account receivable is that it's much more easy to liquidate such a note. That is, it can be sold to a bank or other financial entity, usually at a discount, to raise cash. Finally, we'd take a look at credit card sales and the cost of financing credit sales, not just credit cards, but all types of trade credit. And we look at how the firm might increase its collections revenues by doing timely collections, not corrections. Okay, this brings us to the halfway point. I hope you are proceeding well and comfortably. If not, please plan on staying late in class, and I will devote as much time as it takes to helping clarify issues for you. Looking forward to seeing you in class this week. Bye-bye.